A reverse stock split is a corporate action that consolidates existing shares into fewer, higher-priced shares. Here is how it works. Think of it as trading 4 small coins for one large bill. The total value stays the same, but the denomination changes. Companies often set a specific ratio, like 1-for-10, to reduce the total number of shares outstanding on the market. The primary goal is usually to boost the share price to meet the minimum requirements set by major stock exchanges. While a standard forward split aims to make shares more accessible, a reverse split is often a defensive move for struggling stocks. It is critical to remember that your total investment value does not change simply because the company performed a reverse split. Investors should look at why the company is struggling rather than focusing on the new, higher share price. Understanding these mechanics helps you evaluate corporate moves with clarity. Like and subscribe for more finance basics.